I'll do a few housekeeping items and then I'll hand it over to Bach and Mark, who are the two co-chairs for the Tax and Private Wealth Group. Bach in Singapore and Mark Andre is in Montreal, Canada. We do record these sessions, so if you want to share it with colleagues after, but just wanted to let you know, you should have received a notification when you joined. I will be renaming everyone just to include your firm names, which we typically do, so don't be alarmed to that. And we want to make sure that this is an interactive discussion. Please, we welcome everyone to participate, chime in, ask questions. This group is here so that you guys can get to know a little bit about each other. Today we're talking about family offices and learn what folks are doing in their respective jurisdictions with regard to family offices. So with that, I'm going to hand it over to Bach and Mark.
Yep. I will start. Hi, everyone. I'm from Singapore. So we had a really good run with family offices during COVID because quite a number of our neighbors wanted to settle in Singapore, and the family office was a good opening. So for today, I have done a short slide to share so that it's easier to speak through. Let me know if you can see my slides. Is it okay?
We can.
Yes, we do.
Okay.
Do you want to do introductions first? You do want to jump in
good idea.
to
Sorry,
Singapore?
I'm so excited.
Buck is too excited to talk about family offices in Singapore.
Sorry. Yeah. So I'm Bok from Singapore, from the firm of Wong Partnership, and my area is in private wealth.
Perfect. Do we want to go? I'm sure more people are going to join in the next few minutes, but so let's try to slowly go through the room, and I'll go last if that works. I don't know. I see Brent is on, so I'll pass it on to Brent.
I'll go ahead.
Your first
Brent
meeting?
Howard. Thank you. This is my first meeting here. Joined Miller Martin earlier this year. Had been at Brian K. Powell Goldstein, if anyone knows that firm. Then our group opened a small office for it's kind of a national boutique, and this opportunity opened up, and I thought it was a way to get back to the Goldilocks nicer size of in between and not too large, but done doing trust and estates work or private wealth for the last 20 years or almost, and obviously everything basic to high wealth and some international work. Otherwise, like to play tennis, sail, walk my dogs with my wife. So that's me in a nutshell. Thank you for having me.
Our pleasure. Moving on to Daniela.
Okay, well, my name is Daniela Rey. I am a tax partner at Brushu and Funes de Rioja here in Buenos Aires, Argentina. So this is my first meeting here.
Perfect. And do you focus more on tax or on private clients?
No, more on tax, corporate tax.
Okay, perfect. Okay, this is the private client side, which I have about private client meeting where I have no knowledge of anything related to private clients.
It's more fun and nicer
exactly. So Buck is our expert.
No, just sharing.
All right, so I think Jenna, maybe it's a good thing to introduce you, or for people that don't know, I think Anna first introduced her.
Yeah, definitely. I'm Jenna. I'm the newest colleague at World Law Group. I just joined a couple weeks ago, so everything's really fresh and new to me still, and I'm here to absorb and meet some of you and eventually get really hands-on into the events and member engagement side of things. So yeah, it's really lovely to meet you all. I'm based in Montreal, just like Mark. And yeah, in my free time, I like to do a lot of yoga. Just a little fun fact for you.
Yeah, I like yoga too.
Yeah.
Amazing. Yeah, it's so much fun.
Yes.
All right, Niraj, I hope I pronounced it properly. Oh, is it? Niraj, you're there? Nope, I don't think that works. So maybe we'll move on to Xiao.
Hi everyone. Hi, my name is Min. I'm based in Singapore. I work together with Bong at Wong Partnership in Singapore.
Great, pleasure. And I'm Mark Duval. I'm a partner at Davies in Montreal, and I pretty much focus on international tax, so both M&A and fund formation which is very far for family offices, but I think where we'll bring the discussion, you'll understand why the topic is so intertwined between tax and private clients.
I will go for it again. Bear with me. So what I hope to do is I will do a very short introduction on family offices in Singapore, just to lay the background, and then everyone please just feel free to chime in. Family offices has a good mix of different areas of law, and like Mark says, it definitely concerns tax as well. Okay, so family offices in Singapore, we really get started with COVID. Prior to COVID, from 2020, we have 400 family offices like in the last 10 years or something like that. Never really quite take off too substantially. But with COVID, since 2020 until August this year, we currently have about 1,650 family office. The growth has been quite phenomenal. And a lot of times during the COVID, it was because our neighbors, the high net worth individual and family in the neighboring countries, wanted to settle to Singapore, and they required a status to do so. So the family officers provide them with a status. So I have also set out in my first slide some of the famous family officers who have found their way to Singapore. So you have Ray Dalio from Bridgewater Associates. We have Sergey Brin, the Google co-founder. We have Mukesh Ambani from Reliance in India. There is Nicky Oppenheimer from the De Beers family from South Africa. Lee Ka-shin from Hong Kong. There is also the vacuum cleaner genius, Sir James Dyson. He set up a branch family office in Singapore. And there is this Liang Xin-jin from Fosun Group. So the structure for family offices in Singapore is quite straightforward. What you need is just a fund vehicle and then a fund manager. And the benefits you reap are this. Under Singapore law, the fund vehicle enjoy tax exemption for what we call designated investments. And designated investments would cover almost everything under the sun, with the most obvious exclusion being immovable properties in Singapore. So even immovable properties outside Singapore are included. And recently, the government also came out to exclude family operating business. So the intention is for the fund vehicle to contain largely investment items. Then you need a fund manager in Singapore, which is the family office. The way we do it is that if all that the family offices manages are funds belonging to the family, then they are exempted from having to apply for capital market services license to manage their investment or deal with equity or capital market products. And family members for the family office purposes is defined very widely. It's linear descendants of a common ancestor that is not too remote. So linear and descendants from common ancestors, and it's been interpreted to include both current and former spouses, adopted children, both current and former stepchildren. So very wide. So long as there is a connection, familiar connection, then you may qualify for the fund manager or family office tax exemption. And as I said, this setup was quite popular during COVID because part of the criteria to set up the family office in Singapore is that you need a certain number of investment professionals. And during COVID, family members were just appointing themselves as investment professionals. And by doing so, allowing themselves to stay in Singapore under employment passes. And additionally, the family office could also employ employees, directors, and again, that's how the high net worth family brought in their other family members into Singapore, right? So, of course, with all these nice things that's given by the government, there is also certain requirements to be fulfilled. So for the tax exemption for family office, there are two schemes, the Section 13O and Section 13U schemes under our Income Tax Act. Section 13O is generally seen as the more junior scheme, lighter requirement. 13U is the one for big adults where the requirements go a lot higher. So for instance, for 13O, the minimum asset that we need to put in the fund vehicle is 20 million. For 13U is at least 15 million. And even in the investment professionals requirement, there's a difference. For 13O, there must be a minimum of 2. For 13U, there must be a minimum of 3, right? And then just to make sure that Singapore benefit, there is also a requirement of business spend for the family members. So for 13O, the business spend requirement is that the family office or the fund vehicle must spend at least 200,000 a year. And then when you go to the 13U, you will see that depending on the size of the asset that's under management, the business spend required go from 200,000 for a fund size of 50 mil to 500 mil to 500,000 for fund size of 100 mil. And this business spend requirement, generally you have to spend it on either the local business spend or other stuff like eligible donations or grant to blended finance. So under 13O, the 200,000 must be spent on local business expenditure. That means paying the lawyers, paying the accountants, paying the corporate secretary, for instance, or other business or professionals in Singapore. For 13U, the 200,000 must also be spent on the local business spend, but the other difference, the 300,000 for family office with AUM of more than 100 million, those can be spent on eligible donations, which largely means donations to charities which are registered in Singapore, and then grants to blended finance structure, which mainly are financing structure to support ESG, the environment and that sort of bonds and investment. Then for the fund, the other requirement for 13O is that the fund must be tax resident in Singapore. For 13U, there isn't such a requirement. The fund can be both onshore and offshore, right? Then additionally, there is also a minimum capital deployment, right? At least 10% of the AUM of the fund or 10% of its AUM or 10 million, whichever is lower, must also be invested in Singapore investment. So through all this means, the idea is that the family office, when they come into Singapore, they benefit from the tax exemption that they get from the Singapore government. And in return, the idea is for them to contribute to the Singapore economy, either by increasing employment or expenses in Singapore, right? And the interesting thing about family offices is that you can structure it in various ways in Singapore. It can be held directly by family members. It can be held through holding companies, or you can stick it under a trust and then do a fair bit of succession planning in the trust structure as well. So all that will work in Singapore. And additionally, where the family offices get large in Singapore, you can also package it with family constitution, family governance, and all the other nice work that we get to do with family office.
Yeah,
Right?
Buck, can
So
I ask a quick question? Okay,
yes.
I think I have 3 questions.
Oh,
I think if we go
okay.
back in your structure with the trust, do they look at the trustee or the beneficiaries to see if the trust qualifies as a, call it, family member?
They look at the beneficiary.
Okay, so you'd make sure that each and every beneficiary qualifies under that.
Correct. Yeah,
Okay.
so each of the beneficiary must be a family member and qualify as a family member. Now we have certain cases, interesting enough, where some families try to use the family office to double up as kind of a employee benefit for their family business as well. So that one can't work. It has to be for family members only.
Okay, I got it. And what's the difference between so why would someone use a structure like this for family offices versus just setting up a normal corporation? Because I think maybe, and correct me if I'm wrong, if I remember correctly, foreign capital gains are not subject to tax in Singapore, and all foreign sources gains, all foreign source income. Is that right? Or it's only capital gains?
Correct. Yeah, so we don't have capital gains. Foreign source income are not taxed unless it is brought into Singapore.
Okay, so is the reason to use a family office to bring it back to Singapore?
No, the family office in Singapore, most of the time they set it up to take advantage of the tax exemption, because you can have funds, you can invest here quite actively and aggressively without paying tax at all. It's really zero tax.
Okay. And they would
Yeah.
do so
That-
they would earn like Singapore-based sources of income.
Yes, they would have
Yeah.
Singapore-based sources of income. They could have foreign income as well. But so long as all this income fall within the definition of designated investments, they're all tax-free.
Okay, that makes
And I
sense.
suppose the other advantage that some of my clients see in having a family office is the consolidation of the family wealth, in investing it on a consolidated basis, so they have a bit more critical mass. And then for some of them, they put a trust on top for asset protection. Asset
Got it.
protection, some bit of succession planning, so that the family office can just continue to generate the revenue. The economic benefits gets distributed, but the family office stays within the trust.
Understood. And is it done mostly for, say, non-Singapore based clients? Or like if you look at your clients that open up like those types of family offices, where were they originally from? I'm just
Um,
curious to see like how relevant could it be for us?
okay, I think a high proportion of them came from Indonesia and China. We have a lot of those. Then a smaller number of them came from Europe, from America. We have some Singapore businessmen who set up family office as well, but that one is not a big proportion.
Got it.
Do you have any clients who might be interested to come over and set up a family office here?
Maybe. I'm just thinking, I'm always trying to keep in mind all these type of plannings, and when it becomes relevant for a client, you can tell them, oh, I know Buck in Singapore, she's doing this for her clients. Maybe we should explore that option.
Yeah.
'Cause
Brent, have you worked with with family offices as well?
Not in Singapore or off-site. Most of U.S. family offices are there's not as much of a structure, and so you can have like just either you truly fully set up an office and it's an operating entity, and there's not really as much tax benefit as it is consolidating family wealth for investment opportunities and for just general family control and management, and then. And I would say there was more of a push to go to family offices, my view, 10 plus years ago. Now, so many of the trust companies have beefed up all their service options that a lot of people just stay with whatever trust company and are basically getting the same kind of benefits, but there's not the tax source benefit of going to Singapore. And I haven't done too much of that.
Yeah, I think interestingly, the same thing is happening in Canada. We follow the US a lot.
Yeah.
And we even have tier 2 firms that rebranded themselves as family offices. So like
Yeah.
not the KPMG and the PwC, but say the layer before, they're not saying to people anymore, I'm an accounting firm. They say, I'm a family office. I'll do all the audits for you, all the accounting work, but on top of it, we'll manage your assets. So you call it like a
Yeah. So
multi-family office. It's
yeah,
probably
it's like,
same thing in
why
the
set
US.
up your own company? Just come into our, yeah. So it's like, yeah. So that's been happening a good bit. So.
We have multi-family office, but when you know the likes of KPMG brand themselves a family office, are they licensed to deal with securities and financial products?
I'm sorry, like it's not the KPMGs of this world, it's just the layer before. So
Oh,
like
the layer before.
I would name them and you would not know them, but I think they do. So they have, I think, a separate structure with their like finance professionals, if you will.
Ah,
Or
okay.
it's within a bank and a trust company structure, and then they just outsource all the accounting work. But either way, they're kind of handling it all internally. So they're even, and it depends on what level of the family office you buy, right? So
Yeah.
there's a lot of that going on, but there's not the tax structure benefit of that with
Ah,
going to Singapore. The only kind of every state's a little bit different. So you might
mm.
pick, if you were going to do a family office and trust structure, you might pick the state that works best for you with that, and you might be in Tennessee or Delaware or somewhere where at least you're avoiding some state tax until it's distributed out to beneficiaries. So.
Like in the US, you hear about the big family offices like the Rockefellers and all that.
Yeah.
Why would they set up a family office? How does it help them?
Well, that was a long time ago, and that's back when all these families were set in like Bessemer Trust, not to, but they were started by, trying to remember his name right now, but one of the old kind of old and still fun, so they would set all that up, but that's back when banks just lent and held money, right? So now a lot of families, when they come up, they can get all those services from the financial institutions, but a lot of those old families that set up their own companies, and sometimes that's become a trust company from the family offices they set up, and a lot of times it might be tied to a foundation as well. So,
Yes, that's true.
mhm.
That's true. The Rockefeller family office is still seen as like the star to aspire to for the family offices in Singapore.
No, that they did the best job. They did much better than the Vanderbilts. So
Yeah, so it's probably two things that you see. Like you have these very wealthy people that have their own family offices. So whenever you have like an entrepreneur that IPOs his company or sells a company for a substantial amount of money, they'll create their family
Mm,
offices, hire professionals to manage their money. And then I think maybe when it's smaller or when they're not as interested as being involved, they have these multi-family offices. Either
yeah.
one or two, three that get together, or they go
uh,
with those accounting firms that we spoke about or trust companies.
Yeah, yeah. But in Singapore, the trust companies have a different license, so they tend not to be able to function as multifamily offices. But we have a lot of financial advisors, asset manager. Those guys they have a capital market license, and those are the guys who will pretend that they are multifamily office and offer the services, the investment services.
mm,
But the challenge for quite a number of the family offices in Singapore tends to be looking forward, tends to be the succession part, right? Because these are a lot of them are foreigners who came to set up the family office in Singapore. And now that COVID is over, their family members go back to wherever they used to be, right? So they go back to UK for their education. A large number go to Australia, where they used to come from. Some quite a fair number of them will go back to the US as well. Then the question that faced the family is always, do we still keep the family office in Singapore? Or should we be setting up another office, family office somewhere, or moving the Singapore family office elsewhere?
mm.
Yeah. So US is an interesting option as I think as a counter challenge to China.
Mhm.
So quite a number of my PRC clients do actively look at the US.
Yeah, I think for tax planning, you wouldn't be, but for maybe
Mm,
security and structure, is probably because I think that's what keeps a lot of U.S. clients. And obviously, with all the reporting and everything, that's kind of changed it. But even if there are tax advantages, sometimes you have U.S. clients that are looking at doing some different offshore things, and then just decide, let's just keep it. And so I think that would be the reasoning.
mm,
Uh,
yeah.
Yeah, no,
which is
I
good.
remember being on a call with a US tax lawyer that said that he would be disbarred that if he would recommend to a non-Canadian, non-US to move to the US because it would just increase their tax significantly.
Yeah, well, it depends on where they're coming from, right? But yeah, it can be that way. But then, like for expatriating from the US, I mean, I've, only had a couple that actually went through with it, but you have so many clients that end up coming to you, especially after they have their exit, out of their companies and
Mm,
stuff. And they look at it all. And then at some point they're like, but they decide the tax is worth being able to come to the US in the US, as
Yeah,
opposed to go through all the hassle, get a travel visa and not have it as their home. So there's a lot of moving parts to all that. So I think a lot of it's just the key people in the US is just the security, and they can stay here and keep their funds here. So, but yeah,
mm.
depending on where you're coming from, it can be it can be a large tax increase to come over here and become of course, you could be a U.S. taxpayer or a Canadian taxpayer just by how long you stay here, right? So,
exactly. And at least I think from I remember one good thing about the US is if you're just a green card, like if you're a long-term resident for is it
mhm.
up to 10 years, you have no exit tax.
if you have a lot, see, I think,
That's
I
a
thought it
step.
was
If
after,
you,
I think it's before you, I think it's after you get past 10 years, you could potentially have an exit tax.
yes, you, I guess you don't. Is that, I'm sorry,
Yeah,
that's what I meant is from
yeah,
1 to 10 or 1 to 12, whatever the number of years, you're
yeah,
not subject to exit tax. You have people that kind of move back and forth.
yeah. So you want to watch that if you're here temporarily. However, I mean, it's, you've got what, a $600,000 or $700,000 exemption, and it's off the capital gains calculation of your assets. So it kind of depends on what you kind of have. It makes a difference on that.
And what's that exemption? The 600,000?
I think, well, you to be covered, I think it's you have to have over 2 million, and then after that, you're looking at doing the excise tax, and then I think it adjusts for inflation, so I can't remember the exact one, but it's around 700,000 that you can apply to your capital gains. So you're saving, you're kind of adding basis to that for your assets. So you have to have a fair amount of capital gains before, or unrealized capital gains before it really becomes an issue for a lot of people. But then, for some people, there's plenty of that. So that's where you're kind of looking at the whole structure. And and then I remember a couple of years ago, I had a client. He was like, I just have a simple structure. I just, and he was asking for a number, and I was trying to introduce him to people who would look at all his information and analyze it all for him, and he'd have to pay for the, analysis. And he was telling people how simple it was, and it turns out it's never simple. You have, your restricted stocks options and this and that over here, and you need an accountant to really look at it and make sure you can calculate out what it truly, what the truly embedded gains are and what's covered under that, or what would be exempt from getting that from the extra exemption you have. So, and then, anything that's a trust or for, a retirement plan, that just becomes almost like an annuity calculation. So you're going to be paying on that every time it ever comes out in the future. So.
Just out of curiosity, Brent, how much would the tax for family office be if we set up one in the US? What kind of taxes will it face? Income
Um,
tax?
it would take it, yeah, it would be, fully, tax income wise, worldwide, minus whatever
Oh, right.
foreign treaties or credits. And then depending on where it's at, it would be, so it's going to get US tax. Depending on what state it's at, it could have income tax. You will probably set it up in a state that would not have an income tax to it. If you have US beneficiaries in other states, those states sometimes try to attach to that and say, well, you're really benefiting it for the other states or for the beneficiaries in the state, and therefore it should be taxed. But there's some decent case law that allows you to, at least as long as you have it structured properly, show that it should not be taxed unless it's distributed out. And so obviously when you distribute it out, it's going to be taxed to whatever rate or tax structure that the beneficiaries who receive it would have it. So it for most US planning, when you're doing the kind of jurisdiction shopping, you're looking for the place that doesn't have the state tax, and you're at least saving on that every year, but you're going to be subject to the income tax. But most of the time, if you have qualified dividends, or most of it's just investment assets and capital gains, at least it's the lower percentages of the capital gains opposed to the ordinary income. And trust or tax the highest bracket after about $15,000. And that was to get people from using trust to get multiple runs up the income bracket. I'm sure every jurisdiction's dealt with this in some way. And of course, they created rules 50, 60 years ago that we use now to kind of, do different things for estate planning and other gifting purposes that are, not anywhere close to the reasons they put it in place. But so you're going to get, the trust itself is going to be taxed at the highest bracket for ordinary income and for capital gains. And so then it becomes a play of, what do we want to be pushing down to beneficiaries who are more often than not in the lower tax brackets than the maximum. And then sometimes it's worth just keeping it all held and protecting it securely and paying the tax. So it's all, all the balance that you do.
And you would keep it in the corporation or in the trust?
Well, it depends. I mean, a lot of times you can have a trust that just has all the assets within it, but you could also set it up within a corporation that's held by the trust.
Okay. And when you get to the trust, you probably get under like undistributed net income taxation for your beneficiaries. Is that
You don't really have that for US. You would for foreign.
it's only
So
for
if you have,
foreign trust?
yeah, for foreign, you have all that recapture. So if you have a foreign trust, and then so if you don't provide the distribution schedule showing kind of what the in what all the characteristics are, basically like a little K, more for us a K1, showing all the income tax characteristics of the distributions, then it just all gets lumped in. But either way, there's a recapture. So any deferred income, once it's distributed out to beneficiaries down the road, is also subject to a kind of a recapturization as if you'd paid it whatever year it was earned, hypothetically with penalties. US, you don't quite have that, but you would have all the income tax structure back in there. But that's also because the trust itself is going to pay the tax, whereas we don't know what happened with the foreign trust, right? So if it's a trust structure, if whatever you distribute out, it's either income that year, or if it gets down, it's ordinary income, capital gains, whatever it is, you push it out, and then the beneficiary is then responsible for that. It most likely they're lower tax brackets, but any income that was kept in the trust is paying that income that year, that income tax for it that year. So there's no concern, if it's US, that it was ever, that you ever had deferred income for years that you might have had in a foreign trust.
Understood. Well, that's interesting. Well,
Yeah.
Is the tax implication for holding a corporation under a trust quite similar to holding a corporation on its own without the trust?
The tax, yeah, well, it is, and it depends on how you structure the corporation. So if it's a pass-through corporation, it's just passing up to the trust, which is typically what you do. If it's a, separate entity corporation, the trust would just be holding it, and then you have the multiple layers: the corporation trust, the tax level, and then what comes out to the trust and when. So, yeah, it would be this. It'd be the same as just being held in the trust itself, opposed to held by an individual.
You don't get taxed twice, right? Not one level at the company level for income generated by the company, and then when the company dividend it up to the trust, do you get tax again at the trust level?
Well, you could. Most of the time, you're setting it up where the corporation's a pass-through of some sort. It's an LLC or it's an S corp. Hopefully, LLC, S corps. You don't have to do for S corp. It's the original kind of pass-through corporation in the U.S., but it has a lot of rules to it. And an LLC, you can limited liability company in the U.S. you can set up to be either taxed as a partnership, like it's a pass-through, or a corporation. So most of the time, if you're doing a holding company, you're going to have it tax as a pass-through. So everything just applies to the trust, and then everything that you distribute out, the beneficiaries passes down to them. Whereas whatever is held in the U.S. trust ends up paying the tax on its own level. But if you had a non-pass-through corporation, that corporation would have tax. Then you would push out dividends, to the trust, and the trust would have tax there, so you could have the double taxation. So I haven't dealt with too many structures that are set up that way, but because most people wouldn't want the double tax.
Maybe I think, at least from my point of view, the only time that what we recommend the client is always to have a blocker. So your LLC or your corporation tax as a corporation, so that the income doesn't flow out to the non-resident.
Yeah, well, that would
Because
be.
you don't want your non-resident to be filing in the US, which I think maybe would be relevant for you, Buck.
No, and well, that could be relevant depending on what kind of company you have and whether or not you're trying to hold income in. And you could do that a lot of times, I think, if you're doing special charitable trust sometimes. So you're kind of controlling more what gets to the trust.
Got it. So you'd have your corp, your trust, and then some non-resident beneficiaries. But you'd make sure to allocate it all to your domestic.
Yeah, as long as you had the discretion to do so, and you weren't going to get sued because you weren't. Yeah, but yeah.
Well, likely you drafted the trust, so
Well, I
then it
know,
works
I
out.
know it works out. You do it that way, but sometimes it's kind of funny with all the plays you're doing.
Yeah.
But yeah.
Well, that's interesting. And that's probably something like it's probably what the OECD is going to be focusing on for pillar 3. individual family offices, and maybe it's never going to apply to the US, but at least for the other countries, I think that's
Mhm.
what they were saying, that it was one of the topics that they were looking to cover.
Yeah,
And
well,
then
kind of fun.
it's going to be fun. That's something that, at least in Canada, the liberal government that we have now tried to do something similar in 2017. They had to backtrack on a significant number of tax proposals, but they still kept some, including some that I think we're just talking about, income sprinkling, just a way that you could have your corporation or your trust, and you try to allocate income to family members in the lower brackets. We now
Mhm.
have rules that would automatically put them in the top bracket if they don't satisfy certain conditions. So you see
Okay,
that slowly
yeah,
all these
Yeah,
findings are attacking them,
yeah,
and
trying to
we are
keep
still
you from
very
consuming
kind.
that.
Singapore, we're still quite kind. So our tax rules still allow us to allocate income to the beneficiary so that the income is taxed at a lower rate. They haven't heard from Canada, so I think that we should stay that way.
I think, yeah. So I think for us in a trust we can, but if the
Mm,
income is a dividend from the corporation,
yes.
then you either have to pay tax in your trust, or if you want to flow it. And maybe I'm going to backtrack. Because Canada and in the US, if a trust has income, it can get a
Mm,
corresponding deduction if it distributes the amount to the beneficiary. So you can
okay.
avoid trust level taxation by making
Yes.
distributions. But then you have to look at the other layer, say the corporation below. If it's a dividend and it doesn't satisfy the conditions where the family members have to be employed full time within the company or have contributed a significant amount to the corporation, in that case, the individual would be taxed on the first dollar at 53%, instead of being in like the 0% bracket, then the 10% bracket, and it would go up like that.
Oh, but wouldn't the company already have paid tax for the income from which dividends were declared?
Yes. So, but we
But
don't
they were
we don't
still.
exactly have a double taxation system. We have like a what they call an integrated system. So the corporation pays about 26.5% tax.
Mhm.
Then when it pays out the dividend, the rate is going to be the total of the two is going to be 53.
Oh,
So 26.5, and then I think it's like depending on what type of dividend you have, it's close to 40%. So when you do your 40 plus 20, well, 26.5, then 40 times 73, you should get around, it's not perfect, we get to 54, 55, but I
Hmm.
think that's how it's
that's a
done.
lot to pay for taxes.
Yes,
Our corporate rates are now at 17%, 17.
that's good.
Nowhere close to 53.
Yeah, well, I think different systems.
Yeah, different,
Yep.
different.
Yeah,
Yeah,
at least
our
we can
tax are
compare when,
not too bad.
yeah. We look at people in New York City and it's like, at least there's someone that pays more tax than I do.
Yeah, I don't know what you'd have to make to live in New York City or LA. Yeah, to to live in with the high level of you know in real estate and all that and everything, live cost of living, and then the taxes in both.
Yeah. I should have, like, another thing to mention. What's interesting is in Canada, you pay 53% tax at 280 something thousand. While in the
Hmm.
US, I think it's like at 2 million or like something close to that.
I
I don't know what
think
the
it's
top bracket is, but
Yeah, well, I think top brackets you get up there like after about 500 or
okay.
more, but I think you only hit but I think typically you would have to probably make over 1 million or 2 million before you really hit those brackets because all the deductions and things you get. So
that's
Got it.
probably why some of the big US guys are running to Singapore to set up family office. It makes
yeah,
sense. They should just pay
true.
the expectation tax and then come over here.
Yeah. Well, I mean, the interesting how you structure it, because if there's any connection, it should be being caught for the U.S.
Mm.
purposes at some point. Um, but I think you're just kind of avoiding as much of the taxes you can, at least the state taxes. But I guess if you structured it right, maybe you could keep it all offshore until until it's distributed.
Yeah, yeah, I suppose.
That's what I had in mind. At least like if a Canadian were to invest in the Singapore family office, you would do it in a way where there's no like the Canadian equivalent of CFC, so there's no income that is imputed to Canada. You keep it all
Mm.
offshore. You don't pay tax. You reinvest, and you only bring it up when you need it, say in 50 years. So like the net present value of that money is going to be significantly higher,
Mm-hmm.
which are generally
Then
the international plays that Canadians
would
have.
you be affected by capital gains?
So there wouldn't be any Canadian tax. So let's say Singapore, let's say we use our structure. You have your
Yeah.
Singapore family office, it earns income as long
Mm.
as it qualifies so that it's not deemed to be, let's call it passive income, that
Mm.
would be subject to tax in Canada. You keep it there, you make sure it's active, there's no tax. And then
Oh.
whenever you want to bring it up, you pay a dividend. If the income was earned in an active business, that's going to be tax free as well. And you're only taxed when you pay it out to your individual. So you could almost bring it back to a Canadian corp. The Canadian corp could reinvest it, and there's only going to be tax on that second generation
Mm.
of income, if you will.
Okay,
We have like
I
a
will call
full,
you.
we have an interesting like a full deferral system, and that's why at least I think Canada, the US, a lot of European countries, they all have like financing structures, IP structures, like entities where they put value that is not going to be taxed at high rate, like at very low rates, and then they bring it
Mm.
back up on a tax-free basis, or at least tax-free for Canada. I think, Brent, like it used to be fully taxable for the US. I think now is it still the case, or you get some kind of deduction for on
For what?
on your foreign dividend? So let's say you have the
We,
Singapore
yeah,
company, it has like say assume income that is not subpart F income. You bring it back up. I
no,
think is it still taxable, right?
I think it would still be taxable. It'd probably be still subpart F, and you're getting more into the income tax weeds than as the planner I typically get. Unless I'll also read more of my notes before I do on the next call here. But I think the problem would be anything that's structured or set up by US is going to be still kind of somewhat attached in some way. Most of the offshore stuff that I've done is when people are coming in or before they're come in, and then they set it up before they come into the U.S. Or they have clients or they have family members that come to the U.S. but they keep all they were non-U.S. and they're able to kind of set it up as an offshore that's structured so that it's making distributions year in year out, but it's all happening offshore. So it means Singapore and obviously growing better and because of the less taxes that are involved there. But once it comes onshore, and gets distributed, it'd be subject to that, and it could potentially subject to the deferral tax depending on what it is. And you get what you do a lot of times with that is you just try to work with how it's all structured and maybe get it to cash when it's coming over. So
Got it. Yeah, so maybe for once Canada has a slightly better tax system.
yeah, you never know.
Yeah, no, and like I think no need to look at your notes next time. It's just I think more given that we have a lot of people canceled the last minute, maybe because it was very early in the morning. I think it's
Yeah.
more of a maybe more unstructured discussion than what we generally have.
Oh no, this is great. It's just that it's
Yeah.
like it's not like I've been working on an international matter the last week, so it's like all those little rules that you look back at your for me, I look back at my
Yeah, your
my research
regs.
my regs and my research charts a lot of times to kind of cover. But that's just because, as everyone knows, tax systems are like all the what counts as a gift from a foreign person. There's so many exceptions. So realistically, as a foreign person making a gift to the US person, you should never pay gift tax. But of course, by the time they get to me, a lot of times they've done it all incorrectly. But I mean, if you read those rules, none of them make any sense. Except for the only way I can think of is as someone went in and bought every little rule. Because like, real estate kind of makes some sense. That's the gift tax. But then there's like or securities that would, could be subject to the state tax, but these securities wouldn't, or this asset would. So so I have a whole list that I just go back and look and let's see what we were giving. Because I
Yeah.
feel like there's no logic to it. It's just a matter of what asset is it and whether or not it qualifies.
Yeah, and I think some of them are not clear as well, depending who you
Yeah.
talk to, like partnership interest and depending it's foreigner. I can't remember which one. There was like weird exceptions, as you said.
Yeah.
It's
And then there's if like realistically cash shouldn't be, but then there's a couple little rules so that rulings that have come out before. So like if most of the time we're like do it cash from the from the from a foreign account to the American account. Don't send it to your American account and then send it to then make a gift to your person who's here in the US, but make it directly from a foreign account. And really, I think if you read the regs, the cash should. But there's been a couple of rulings enough that all of us say that shouldn't happen. However, what we always tell the client is make the cash distribution from your foreign account to your child's US account. So it's cash coming from a foreign source for sure, that we can show for the exception.
got it. Maybe that's we
So
had a
yeah, there's all
client
those little
ask
rules
something
and then
like that, like, oh, what
yeah.
if I transfer the funds to your trust account and then your trust account transfers it to the children? Like we didn't do it, but we had someone ask us to do it, and we are like, oh, maybe that was because of the gift rules, the gift tax.
Yeah. Well, you just have to look and see whatever you're gifting and how you're gifting it, whether or not it qualifies. Because otherwise, if like in the US, we have the exemption amount, which is insanely high right now in some ways at 13.61 and potentially dropping in 2026. However, it's only 60,000 per year or 60,000 total for a foreign
Yeah,
person.
except
Yeah.
Canadians.
Well, does that
It's
work for the gifted?
prorated, so we get the full
Or
exemption prorated based on the value of the estate in the US versus worldwide.
and that's for lifetime gifts or just the death for the
Uh,
estate?
both.
Okay. Well, if you follow into a treaty where you get that and you have it for lifetime gifts, true, then you can get it. But if you're
But then
not,
people don't think
yeah,
about it and say they have $1 million in the US and $1 billion in Canada, so their exemption is nothing.
yeah. So yeah, depends on So depends on what you have, but so the it's just a matter of making sure you kind of follow through that because otherwise you're paying gift tax, whereas if you're US, you probably wouldn't based on the value of the gifts that you made. So you have to make sure you're getting through those exceptions, or it could be a lot more tax than you're expecting. 40% after the first 60,000 you gave away. So
And it's 40% of the fair market value, which
yeah,
is to me is
on the
crazy.
day on the date of gift, yeah.
Yeah.
Fun stuff.
That's why I like say Canada is so close to the US that probably 70% of the international tax that we do as a US component.
Probably, yeah.
Probably even more. It's probably probably similar to you, Buck, with China, I would assume.
Yeah. Well, we China, we deal with some of the taxes, but not that much. We actually set up more trusts involving the US. Foreign grantor trust, putting up onshore trust. We have a fair bit of that because Asian parents, a lot of them would send their kids to the US for education. And a lot of them will
Mhm.
settle down there, right? So when the parents come of succession planning age, they look around and then they have all these children in different parts of the US. And succession planning becomes quite tricky involving the US tax and all the considerations.
Mhm.
China so far it is simpler because China is just coming out. Nobody is going in. So the tax issues are not so bad for us.
Do that. Yeah, but what you're describing is what I'm talking about is most of the offshore is
Yes.
where the family's kind of partly moving in, but not all. And
Yes.
hopefully the generation with the wealth hasn't moved in yet. And you can do
Yeah.
all the parking.
Yeah. Yeah. But we have done some for US citizens who renounce their citizenship.
Oh, yeah.
renewal their citizenship to come out to Singapore. We had a couple of those, but a lot of times the US tax are dealt with by US lawyers like yourself, I suspect.
Yeah. Didn't catch the last part completely, but yeah. The problem is you're covered most of the time if you do that. So the problem is when people want to come off, a lot of times it depends on what you want to do for your family that's staying here, right? If everyone else is leaving or out, then you can set up a lot of things and do different things. But if not, then you're always that the children in the US could potentially be paying the state tax in every distribution they'd be getting from the trust. Unless they're coming out as well or exiting
Yeah.
before they're starting to become beneficiaries.
True.
So then you tell your client, well, if you want to do that, go ahead and use your entire exemption, fund the trust for your children, then leave. And they go, give up 26 now. Yeah, so, that's why you have all these discussions. And I've only had a few ever actually truly exit.
Are any of you coming to Singapore anytime soon for Step Asia conference, perhaps?
No plans
I-
right now, but
Yeah, same thing here. Well, I think in 2029 I'll be there because IFA is going to be in
2029.
Singapore in 2029, I believe.
Ah, okay. I thought you're seriously into forward planning. 2029 is so far away.
So Mark, are you attending IFA in Cape Town at the end of the
So,
month?
so I'm not going to Cape Town, but
Okay.
I'll probably be at every single one after.
Okay.
Because I think it didn't work out this year, but I'm the chair of Yin IFA in Canada, and I'm involved with the IFA Central as well. So I kind of have to be there just this year. Just with Cape Town and the time of the year, it's not going to be possible.
Brent, do you take part in IFA as well?
I don't think so. I'll have to look into
Neither
that.
have I. Yeah.
Yeah.
Yes.
Is that only for tax lawyers, or is there a little bit of space for private
Okay.
wealth lawyers?
Yeah,
Because
so
I'm part
also
of STEP, so I imagine that might be kind of more private wealth than you thought, but I'll have to look
Yeah.
into it.
exactly. So IFA is International Fiscal
Mm.
Association. So
Yeah.
it's all international tax. There's a bit of private client, but it's mostly going to be on the tax components of it.
Yeah.
And maybe as I
Whereas
see, like,
STEP is completely private client.
exactly.
The
Exactly.
whole
Yeah,
time.
it's the language that we know.
And then if
The-
we get
the
really
complete-
confused, we ask the FF people to explain the income tax rate to us.
But
I
you
see
should
we have
try coming by to Singapore, you guys. Just drop by for Step Asia or something. Yeah.
Yeah,
Don't wait
maybe
till
I'll check.
2029. It's too far away.
Yeah, but
Well,
like Singapore is
check
beautiful,
it out.
so it's worth
Yeah.
it. It's really worth
I
it.
imagine it would be. Yeah.
I see we have 4 minutes left, and I just wanted to see how should we, like, I see generally we have about like 20 people. I think now, I don't know if it's the time that was harder, at least for, I think all the Europeans are probably not, like, we're probably not able to join because of the time. Is it for next time? Because I think that our next meeting is going to be on tax. What do you guys think we should do? Should we do one? We generally alternate from 1 a.m., 1 p.m., which I think
Yeah, I
is
think we
hard for you,
do.
Buck, right?
Right. The next session would be the morning one that's more suited for Europe, I think.
Yeah, and so I think we do tend to have smaller groups with the private wealth side, just because of the nature of the participants. That being said, I think our sweet spot has really been the this time zone, 8 to 9 o'clock our time, which is, I know we're going through a time change now, so it will be a wider gap with us with Asia, and Europe, I think, goes through their time change at the end of this month.
Mhm.
So it's probably 1 o'clock there now, 1 in the afternoon.
Yeah, I would assume that reasonable time. I would say for US, this is fall tax day. So luckily I didn't have too many pending gift tax returns and things. I've got a few, but I could see a lot of people that are really helping a lot of their clients finalize and get with their CPAs to get those things out. Wouldn't have signed up, in many years, I wouldn't have signed up for anything on a April or October 15th, but I knew I didn't have too many hard deadlines this year. So that could be where US folks are.
Listen, I should know this, being in the US, that the 15th would have been US tax day, but it totally, I always just think of the April date, right? It totally escaped me that
Yeah.
October
The
15th.
April date, that's
Nobody pays their taxes in
for all those easy W2ers. But anyone else with K1s for multiple,
Yeah.
even partnerships. I mean, of course I moved here from, it's like I didn't even get my K1 until like late August. It makes it even tough to know how much you should be estimating. But anyway, fun stuff. But anyway, so I think you'd probably have more US folks next time just because you won't be on tax day.
Perfect. So I guess our next meeting is going to be probably in January, or?
I would say Q1 January or February. And I think I did send around some dates to you guys. I don't know if we put that on the calendar. I'd have to double check. But yeah, it would be Q1.
Perfect.
Yeah.
Yes, this time on tax, if you have any suggestions of what the topic should be, feel free to email Bach, myself, or Piotr, who's not here, but he's in charge of Europe.
And Brent, next year in October, we'll do it on the 17th and we'll have a cocktail hour, okay?
That sounds good. I mean, I realize there's balancing going on everywhere. I'm just trying to explain why you're like, yeah. And of course, I have no idea. This is my first meeting. I might be the only US person, but I would imagine you have more US folks on here. And that's probably where they are this time.
Yeah, I think there are a number of US member firms, but probably not a lot who participate. It's
Okay.
Yeah, I
good
think we usually get some participant from our East Coasters. So Loch Lord, I think we've had somebody from their firm attend in the past. And Faegre in Chicago has also attended in the past. But our West Coasters, I mean, this time is hard for them.
Yeah.
Whether we do it at 8 a.m. or 9 a.m. Eastern, it's still really early for them.
Yeah.
So
I can imagine
sometimes we'll get them in the evening. And Bach, you've met we have a gal at Greenberg Glusker that Bach did a program with on the private client side last fall. So we try to change up the time so that everybody gets an opportunity at some point to join one of these calls.
Oh, that makes a lot of sense.
Yeah.
Well, thanks for having me.
All right, well,
Yep.
thanks
Thanks so
everyone.
much, everyone. Thank
Joining
you.
tonight, Brent and Bach, Mark, we'll be in touch.
you.
Yes.